Did you know that 5 of the biggest reasons why traders fail are things they do to themselves? Many traders unwittingly sabotage their own trading success. They are solely responsible for their account's eventual demise. Fortunately, it's not too late for you, even if it could be for these traders. We want to ensure that you don't have the same blind spots and may, perhaps, escape the same fate as others who had their account blown. We call them the O's of trading. What exactly are the 5 O's? Stick with us in this episode as we will be explaining the 5 deadly O's of trading. Number 1. Overconfidence. Overconfidence is more than just feeling that you can handle anything. The definition of overconfidence is an overestimation of one's own trading skills. Being a good trader demands a great degree of self-assurance. When you are confident, you are more likely to take risks or look for opportunities. Believing that your trade have the potential to be profitable is one thing. Believing that you are an expert in the market and that you can never lose, since all you do is win, is quite another. Despite the fact that confidence is needed, being too confident may be harmful. This phenomenon is called the overconfidence effect. The overconfidence effect is a cognitive bias in which a person subjectively perceives their judgment to be superior or more reliable than it really is. Essentially, when you have a high degree of confidence in yourself, you have a higher opinion of yourself than an objective and reasonable person would have of you. According to psychologists, there are 3 different ways in which overconfidence presents itself. They include overestimation, overprecision, and overplacement. Overestimation refers to the behavior of exaggerating one's ability. Overprecision is the tendency to think too highly of one's own understanding of the truth. Overplacement is when your results are measured against those of another individual. People who are overconfident have the mistaken belief that they are superior to others and have an exaggerated opinion of their own knowledge and capabilities. In order to lessen the impact of overconfidence, you should familiarize yourself with your strengths and weaknesses. Understanding your limits can help you avoid wasting time and energy on opportunities that aren't worth your while. Above all, you must always consider the possibility that you are incorrect. Listen to new information and know when to change your mind. You need confidence to trade, but this confidence has to be tempered with intellectual humility. Number 2. Overtrading. Overtrading may refer to trading excessively often, engaging in unusual big trades, or taking inappropriate risk. Traders that are consistently profitable have remarkable patience. Because high-quality setups take time to emerge, they must be patient and wait for confirmation. It doesn't matter whether the setup takes 2 hours or 2 weeks to complete. They will wait until the chances are more in their favor before entering the market, since this is what really matters to them, protecting their capital. If you are overtrading, you'll be able to tell. If you close a trade at a loss while knowing in your heart you shouldn't have taken the trade, you are guilty of overtrading. When you should be trading the daily chart, do you find yourself checking at shorter time frames like the 5-minute chart and discovering better trades there? Do you ever find yourself spending hours staring at charts while trying to force a trade with a setup that is good enough? When you spend too much time gazing at charts, you run the risk of getting into a trance as a result of looking at so much price movement and indicators, which might make you to believe that magical setups are beginning to materialize, when in reality, they are mirages. This behavior is known as overtrading. Trading requires patience. The long-term winners are those traders who hold off until they are good setups and then hold their positions. Pay attention to what you are doing. It always isn't about the money. Number 3. Over-leveraging. Leverage is a capacity to initiate and manage a much bigger trading position with a relatively little amount of money in your account. For instance, your broker could let you open a $100,000 position with a $1,000 deposit. This is a leverage ratio of 100 to 1. One of the benefits of using leverage is that it enables you raise your profit while only requiring a certain amount of capital. Leverage has a downside of magnifying your losses, however, which may lead to rapid depletion of your account if you are not careful. When trading with a high level of leverage, even a little price movement might result in a complete loss of capital. Your account's equity will be more unstable the more leverage you use. There is a high possibility that you may experience a margin call. It will be difficult to keep your emotions in control and avoid allowing them cloud your judgment when the equity in your account fluctuates widely as a result of highly leveraged trades you have made. In order to succeed as a long-term trader, it is best to limit your exposure to leverage. Even if you have access to lots of leverage, you shouldn't necessarily utilize it. As you gain experience, you'll be able to decide when and how much leverage to use to help you reach your financial goals. The most important thing to keep in mind while using any degree of leverage is to trade with caution. Leverage taken on excessively lowers the chances of profitability. Number 4. Overexposure. It is important to monitor your risk exposure if you have several positions in your trading account, especially if those positions include multiple currency pairs. Trading currency pairs that move in the same direction, such as the Australian dollar US dollar and New Zealand dollar US dollar, is virtually always the same as having two identical trades open. This is due to the fact that both pairs move in the same direction. You may not want to select both pairs despite the fact that both have outstanding trade setups. Selecting one of two setups could be preferable. Although trading in several pairs may provide the impression that you are spreading or diversifying your risk, the reality is that many pairs tend to move in the same direction. As a consequence, rather than reducing risk, you are raising it. You are placing yourself at a much greater risk without even being aware of it. Overexposure is the term for this. You need to understand how various currency pairs move relative to one another, unless you only want to trade one currency pair at a time. Understanding the concept of currency relationship is essential. Before we drop the last and final of the 5 deadly O's of trading, drop a like if you're enjoying this video, share to someone who you feel should see this, and hit the subscribe button to enjoy more videos like this. Are you done? Come along, let's go. Finally, number 5, overriding stop losses. Stop losses are pending orders that when losses reach a specific amount, essentially close out your trading positions. Giving up some of your pride might be a good strategy if you want to keep trading for a longer period of time. Although it might be tough for you to accept that you are psychologically incorrect. Do you possess the mental toughness as well as self-control necessary to keep to your stop loss? What distinguishes long-term winners from losers in the heat of battle is their ability to pursue their predetermined strategy objectively. Traders, particularly those with less experience, are prone to second-guessing themselves and losing their perspective as the misery of a loss begins to set in. With the thought I am already down a lot, more negative thoughts flood in. You should probably simply keep going for the time being. Maybe this is the moment the market decides to turn around. Wrong. Your reason for trading is no longer valid if the market has reached your stop loss. Thus, it is time to exit the market. It is not recommended that you widen your stop. Even worse, don't remove or override the stop or just let it ride. Increasing your stop loss would only result in a rise in your risk as well as your loss. In the event that the market hits the stop loss that you set, the trade will be considered closed. You must learn to take the hit in stride and move on to the next opportunity. It is illogical to increase the size of your stop loss since it would have the same effect as if you didn't have any at all. To succeed as a trader, you must first rid yourself of these traits and focus on your trading plan. With that, you can beat the game and earn successfully. Did you learn anything new from this video? What other mistakes do you think newbie traders should avoid? Let us know in the comments below. Till next time, this is a Thrive FX.